How y'all doing? We gonna react to my boy Keith D, and he's gonna be talking about bonds. This is a finance channel and self improvement to better yourself and to show you the truth about wealth. So we gonna react to the video.
Worth over $100 trillion that impacts your mortgage, your job prospects, your stock portfolio, and even the price of Bitcoin. The reality is, a lot of people don't know how this market works. No, it's not stocks. No, it's not crypto. It's actually the bond market, and
Yes,
it's
sir.
the most important piece of the global financial system. So, what is
Yes, sir. If y'all don't know, like every single time I react to a video about finance, I say the same thing. Do not invest your money in anything where you don't have a high chance of return. Treasury, bonds, S&P 500, mutual funds. Do not invest your money in nothing where you don't have a high chance of return. If you have a good amount of money, you can do real estate. I'm telling you guys, stop day trading. Stop. It, you guys will day trade, have a 1% chance. You have a 1% chance. It blows my mind. You have a 1% chance of making money. Add your money to the S&P 500, you have, you have a high chance of making money. It's been going up for the last 100 years. For the last 100 year, for the last 100 year, it's been going up every year. Come on, man. Same thing with mutual funds, right? Y'all gotta educate yourself and do stuff to have a high chance of you making money. Yeah, it's $10 that you have, but guess what? It's gonna compound over time.
the bond? Imagine you're starting a business. You've got an amazing idea, you've got all the drive in the world to make it happen, but you just don't have the money. So you go to someone who does and you borrow it. You make them a promise. You say, hey, I'll pay you back and I'll give you a little extra on top.
Yes, sir.
That little extra on top is called interest.
Yes, sir.
That is the cost of using someone else's money. A
Yes.
dollar.
By the way, interest is a scam, right? But it's a scam that you're aware of. So you're not being misled. You're not being tricked. It's a scam, but you know about the scam. Interest is a scam. If you owe somebody 140K, you should just give them 140K. Okay, 1 or 2%. Okay, but 8, 10, 11, 12. That's a scam. That's a scam. So how bonds work is they the banks give people money and they pay them their money back and they make money from the interest. And you could put your money in a bond and these banks could take the money from the bond and give it to these guys, and when they make their money back, when these guys pay them back, these these banks will pay you money, give you money back in the bonds. So this is what I'm talking about when you take high chance risk. It's a high chance that you're gonna make money. This is what I'm talking about. Stuff like this. Stop day trading. Stop trying to start a business. If you I'm gonna make another video about that. How to go about business. But that's how it works.
Today is worth more than a dollar tomorrow. Because if you have a dollar today, then you can use it to take advantage of opportunities as they arise. When someone gives you that money now, they're giving up that potential. So they want to be compensated for that. Because otherwise, they could have taken that same money and invested it in their own business or some other opportunity or even something like the S&P 500. Now, people and companies often borrow money, but so do governments. And when a company or a government needs to borrow money, they do it by issuing bonds. That makes them the borrower or the issuer of the bond, And the investor is the lender. The US government is always spending money, whether it's on defense, roads, healthcare, or social security and beyond. And while a lot of that may sound altruistic, in reality, it's also strategic. Governments spend to stimulate productivity because productive citizens and businesses generate tax revenues. Most of a government's revenues are going to come from taxes. So in the United States in 2022, 54% came from personal income taxes, 30% came from payroll taxes, and 9% came from corporate taxes, while the rest was from excise taxes and things like park fees and so on. But here's the thing.
Yeah, I love to see this, man. I don't see a lot of other black men that just carry themselves a certain way and educate themselves. You know, everybody want to be a top shooter and be a rapper. So when you see, I'm black, by the way. So when you see stuff like this, it makes you feel like, oh, we're leveling up, we're slowly improving, but it's very slow, but at least we're improving. I'm tired of seeing every every black person thinking it's cool to be a gangbanger. I'm glad it's somebody like this. I'm seeing another. I'm seeing another like-minded individual.
The US government tends to spend a lot more than it collects in revenues. And that gap between what they collect and what they spend is called the budget deficit. And every time we run a deficit, we're adding to the total national debt, which is the amount that the government owes from all past borrowing. Deficits are annual, the total debt is cumulative. The last time the US government ran a budget surplus was in 2001, which I find surprising because it's a very different picture from where we sit today. In 2024, the US had a $1.8 trillion deficit. So, where does the extra money come from? The US Treasury borrows that money from the public by issuing bonds. As the government needs cash, the Treasury holds auctions, selling bonds to investors all over the world, and people tend to buy them. Banks, pension funds, insurance companies, even foreign governments, and also regular American citizens. Why do people show up to these auctions? Part of it.
Let me tell you why. Listen, 10% don't seem a lot. Yeah, cause you have your weekly check. Weekly check is 1,000, 500, 800. It don't seem a lot. But when you have 5, 6 million, 100 million, and you're making 5% of that a year, 10% of that a year, 10% of 1 million is 100K. 10% of 10 million is a million. 10% of 100 million is 10 million, right? 10% of 5 million is 500K every year. Every year, and it's a high chance that you're gonna make that. It's a high chance. This is all I was telling you about the S&P 500. They've been going up every year for the last 100 years. It's a high chance that you're gonna make a return on your money. And if you don't, and if you don't make a return on your money, it's a very small, very small. And I've never seen that happen. Usually they'll make 10%, but if they don't make 10%, they probably make like 7 or 6%. So this is what I'm telling y'all. Y'all gotta invest your money right.
It's because US government bonds are considered one of the safest assets in the world. The day that the United States defaults on its debt would be a day where we probably have much bigger problems to deal with. So let's break down some of the terms around bonds. First, you have the principal, which is the amount being invested or the amount being borrowed. Then you have the coupon, which is the interest payment, or the percent that you're going to receive on that bond on a yearly basis. Then you have the maturity, which is.
As a therapist myself, I know how important it is to be able to have someone that you can talk to about your problems, to bounce ideas off of.
When the loan is due, or how long the investor has to have their capital tied up. Finally, we have the yield, which is the return that the investor gets from the bond. And the reason that this is different from the coupon is because the price of the bond can change, which then affects the actual return. Bond prices go up and down, but the coupon, the dollar amount being paid on that bond, stays the same. And so because of that, the yield can move up or down based upon the price of the bond. If the price of the bond falls, then the yield rises. And if the price of the bond goes up, then the yield will decline. Let's say you have a $1,000 face value bond, and that bond pays 3%, which is $30 a year. A few months later, there are bonds that get issued at 5% for $1,000, so paying $50. The bond that you previously bought paying $30 is now less attractive on the secondary market. So the price may drop to, let's imagine, $900. But you're still getting that same $30 coupon on that bond. So now, if you take that $30 and you divide it by the current price of $900, now you're sitting at a yield of 3.33%. The opposite is true if rates were to fall. In that case, bond prices would go up and the yields would go down. So where do these market-based interest rates come from? Treasury auctions are one piece of that puzzle. The government sells bonds on a set schedule, weekly, monthly, depending upon the maturity of the bonds that they're selling. And the yield at auction depends upon how much demand there is at that auction for these bonds. This is called the primary market. When new treasury bonds are auctioned in the primary market, the yield at which they are sold becomes a benchmark, and investors in the secondary market look at this yield to reassess the value of similar bonds already in circulation. Investors are constantly buying and selling based on their expectations. Will the Fed hike or cut rates? Is the economy speeding up or slowing down? Do we expect inflation in the future? These are the kinds of questions that bond investors ask themselves to determine what yield makes sense for them to lend their money out at. The result is that the market interest rates are really just the yield that global bond investors are demanding at any moment in time. It's all based on what they think the future holds. Now here's where things get interesting, because if market rates go up, then the cost for the government to borrow also rises. Right now, the US government has over $36 trillion in national debt that they have borrowed from the public over time. The key ratio to watch to get an understanding of what that debt really means is called debt to GDP. It's a way to look at how much we owe versus how much we produce. It's kind of like how much do you have in your credit card balances versus how much is your annual income. This can kind of give you a better idea of how healthy that debt is or how likely the person is to be able to pay off that debt within a certain period of time. But what's even more important is at what rate are we paying interest on that debt? Because when rates go up, then the government has to spend more just to cover the interest payments. And that burden can grow fast because right now a lot of government debt is in short-term treasury bills. These treasury bills are constantly resetting because they mature in time frames like 6 months, 12 months, and 18 months. So the government is constantly using these short-term treasuries to fund their borrowing.
Let me tell you something. Treasuries is where majority of extremely rich people put their money is in treasury. A lot of billionaires, hedge fund managers, a lot of them put their money in treasuries. Like Mark Cuban said it himself on I forgot what podcast was it. He said it himself. A guy won like it's a guy that won. I think he won 2 billion in a lottery. I think he won four, and after taxes he had two. Mark Cuban said if he put like 1 or 2 billion inside a treasury, he's gonna make 100 million a year guaranteed every year. So that's what I'm talking about. Like treasury is where extremely rich people put their money at. It's one of many places. Treasuries and bonds.
Process is called rolling over the debt. What the government would like to do, as we're seeing in the news, is to get rates lower so that instead of using these short-term treasury bills to fund their borrowing, they can then lock in a lower rate for longer-term bonds like 30-year or 10-year bonds. When you want to borrow over a longer period of time, you want the rates to be lower. When rates are high and you borrow in the long term, it's like setting in your mortgage rate at 7%. Here's something that we have to think about. Every 6 to 12 months or so, we have these short-term obligations that the government is then refinancing again. But also, you have older borrowing that was done in the past over, say, 10, 30-year periods that's also now constantly coming up. The government is taking what was once long-term debt and rolling it over into these short-term maturities. And as that happens, more and more of the total debt burden is reliant upon present-day market interest rates. If rates were to rise, then so will the cost of interest on the debt. And as that happens, it starts to crowd out the spending on other things like defense and healthcare. That sometimes will lead to cutting expenses or even continuing to borrow more heavily to find ways to fund these obligations. And that's why bond yields matter. Not only does it impact your mortgage, but it also shapes the financial future of entire countries.
Yep.
There's more to this that's going to impact your stock portfolio, so pay attention. When interest rates rise, government bonds essentially are offering a better return with no risk. Now, on the other hand, stocks are ownership in a company, not an obligation for a company or someone to pay you over a specific period of time. So if that business struggles, or even if the economy slows, then the price or the value of
Yes, guys. Like I said, guys. I'm a short-term investor, so I do trade, but I'm not a day trader. I hold for like months and I hold for years, right? And this is the only fundamentals that I use. Interest rate is the only fundamentals that I use for that exact reason. Interest rates and bonds is is what moved the country, right? That's what moved the country. That's what determined the country future. So using that alone for your fundamentals for trading, that's wonderful. And that's why I make money I'm profitable every year. Every year.
stock can go down and even down to zero. Bonds are very different, especially US Treasuries, because the only way that you don't get paid is if the government defaults. Otherwise, you're going to get your money back with interest. So when Treasuries start offering 5%,
you don't need a second job. You just need to know these AI tools. It's 2025.
And stocks have an expected return, let's say, of 6%, then investors
Yep, yep. And that's why a lot of investors and all of these rich guys, that's why a lot of them not buying treasuries at the moment. They're waiting for the interest rates to interest they're waiting for the interest rates to drop, right? That's why gold that you realize gold been going up all last year and this year? It's because America interest rates keep going up. So it's bad for the future. So all these investors are holding for years. They see this, they see this, and you know what they do? They see this, and they short the market, and they buy gold, and they buy stuff that go opposite of the U.S. economics, and they hold it for a couple of years, 1 or 2 years, and then when the interest rates drop, they switch it. It's I can't get out too much information. I can't get out too much information.
are going to ask themselves, am I really going to take the risk of buying a stock that's going to give me 6% when I can get a guaranteed 5% from the government? That interest rate for government bonds is called the risk-free rate, and the 1% spread between the expected value of the 6% from the stock market and the 5% from the government bond is called the equity risk premium. When bond yields rise, that
Yes,
premium
sir.
shrinks, and as that happens, investors start to rotate out of stocks or sell them. Now, that was the equity risk premium, which is the
Yes,
difference between
exactly, exactly. So the interest rates were too high last year. They had to bring it down. You want to know why? Because investors are not going to give them money. Investors are not going to give them money. So they're not going to have the government ain't going to have enough investment funds. So for them to have money to invest, they have to bring the interest rates down because it's costing the government too much. And it's going to be harder for these guys to get their money back. So these guys are not going to be giving the government no more money until the rates drop. So they're gonna do some stuff and fix some stuff to make them rates drop. And when the rates drop a certain amount, that's when these guys gonna add their money right back in. They're gonna add more money right back in the treasury. They're gonna add more money right back in the bonds. And for the next 5 to 6 years, it's the same thing over. It's just a cycle. For the next 5 to 6 years, maybe 3 or 4, it's just gonna be going up for the U.S. economy. And then when the interest gets too high, they they gotta go into short term borrowing, and those investors are not so interested no more. And America needs some money, so they're gonna drop it again.
The risk-free rate from the government, and what investors would need from a stock in order to justify taking that extra risk. You have a similar concept in the bond market, and specifically between government bonds and corporate bonds. When fear in the market rises, investors demand higher interest rates from the corporate bond market. Companies tend to have different credit ratings and a real potential to actually go bankrupt. The gap between safe government bonds and risky corporate bonds is called the high yield spread. When that spread widens, it's usually a signal of some sort of trouble in the markets. The bond market doesn't just reflect economic reality, it also shapes it, because as interest rates rise, it can start to slow down the entire economy. One more thing.
That's what make the market go up and down. I'm telling y'all a little bit too much. I'm telling you a little bit too much. I can't say too much.
The yield curve. Normally, long
Like it's easy to make money over the long term. It's easy, very easy. They try to lie to y'all. You gotta be an extremely smart guy to beat the market. Nah, just follow this. This is what make the market go up and down right here. This will make the market go up and down every year. This will make the market go up and down. This shit right here. This shit right here is what make the market go up and down. This is the reason for it. Short term, what make the market move in a week, a month, not a month. What make the market move in a week, 3 days, day trading in a couple of seconds and a couple of minutes, that's manipulated. But they cannot manipulate it over the long term. That's illegal. And it costs too much. Because to manipulate the markets, you have to put money into the markets to fool it. So to manipulate it for years, it's gonna be a lot of money. That's gonna cost more. That's gonna cost trillions to manipulate it for years. So you cannot do that. And even if you can manipulate the market for years, right? Even if you can, that's extremely illegal. Not only is it illegal, who the fuck is gonna spend trillions of dollars just to make the market go the opposite way for 1 or 2 years? Nobody gonna do that. You can manipulate the market, but only for a couple of minutes, and probably only for a couple of days. But that shit gonna cost way too much to manipulate it over a long period of time. Way too much. And maybe people do it, but you're still gonna make money. Like it's literally impossible not to make money. And this one of the secrets. And this is why I say you guys are gonna take high chance risk. It's a high chance that you're gonna make money.
Term bonds are going to pay more than shorter term bonds because locking up capital for a longer period of time is going to have a larger opportunity cost as things continue to change and your money's tied up in a bond. But when short term yields are higher than long term yields, then you have what is called an inverted curve. When the yield curve inverts, investors are basically saying they prefer long-term bonds compared to short-term bonds because they're expecting either an economic slowdown or another reason for rates to decline in the future.
Okay. That's the video. But yeah, that's literally what controls the market. Um, I don't like sharing my strategies like that. I ain't gonna say how I use it to my advantage. But yeah, that's literally what that's a huge portion of what could control the market. But that's